Have you ever wondered what would happen if the world's biggest borrower suddenly couldn't find enough people willing to lend it money? Most Americans never think about this because it sounds too technical, too distant, and too complicated. But the truth is, some of the biggest financial shifts in history started quietly, long before the average person noticed anything had changed. If you clicked on this video, you're already different from most people. You're not here for celebrity gossip or quick entertainment. You're here because you want to understand what's really happening beneath the surface of the economy before everyone else does. That mindset alone puts you ahead of millions of people who only pay attention after a crisis has already arrived. So stay with me until the very end, because what we're about to discuss could completely change the way you think about money, investing, savings, and America's financial future. For decades, the United States has enjoyed an extraordinary advantage. Whenever Washington needed money, investors from around the world lined up to buy U.S. Treasury bonds. Governments, pension funds, insurance companies, central banks, and large institutions all viewed treasuries as one of the safest places to store wealth. This constant demand allowed America to borrow enormous amounts of money while keeping confidence in the financial system intact. It became the foundation of the modern global economy. But today, an uncomfortable question is beginning to emerge. What happens if those buyers become less willing to keep buying at the same pace? This isn't about one dramatic event happening overnight. Financial systems rarely collapse in a single day. Instead, they change gradually. Investors begin demanding higher interest rates. Governments pay more just to refinance old debt. Budget deficits grow larger. Interest expenses consume a bigger share of tax revenue. Eventually, what once looked manageable starts creating pressure across the entire economy. The danger isn't simply that fewer buyers exist. The danger is what happens when confidence slowly begins to weaken. Think about it this way. Imagine a family that has always been able to refinance its mortgage because banks trusted them completely. One day, lenders begin asking for higher interest rates because they're becoming more cautious. The family can still borrow money, but every new loan becomes more expensive than the last. Their monthly payments increase. They have less money available for everything else. Over time, even without missing a payment, financial stress starts building. Now imagine that same situation happening on the scale of the United States government. This is why Treasury auctions have become one of the most closely watched events in global finance. Every auction provides a snapshot of investor demand. Strong demand can reinforce confidence, while weaker demand may force higher borrowing costs. No single auction determines the future, but taken together, they help economists and investors understand how markets are reacting to America's growing debt burden. These signals matter because the United States must continually refinance existing debt while also borrowing to fund new spending. One of the biggest reasons this issue is receiving more attention today is the sheer size of America's debt. Every year, more debt reaches maturity and must be replaced with new borrowing. At the same time, budget deficits continue adding even more debt to the total. This creates an enormous refinancing cycle. If borrowing costs remain elevated, interest payments alone can consume hundreds of billions of dollars that might otherwise support infrastructure, education, healthcare, or national security. Another important change is the behavior of foreign buyers. For many years, overseas governments accumulated massive amounts of U.S. treasuries as part of their foreign exchange reserves. While treasuries remain an important global asset, some countries have diversified more of their reserves into other currencies, gold, or domestic priorities. That doesn't mean foreign demand has disappeared. It simply means the automatic growth in demand that many investors once expected cannot always be taken for granted. When foreign demand slows, domestic investors often purchase a larger share of treasury issuance. Pension funds, mutual funds, insurance companies, banks, and individual investors continue playing an important role. However, if borrowing needs keep rising faster than investor demand, interest rates may need to increase further to attract enough buyers. Higher Treasury yields influence almost every corner of the economy because they affect mortgage rates, business loans, auto financing, and corporate borrowing costs. This is one reason respected investors like Ray Dalio often encourage people to pay attention to long-term debt cycles rather than focusing only on short-term market headlines. Debt itself isn't automatically dangerous. Problems arise when debt grows faster than the economy's ability to support it over long periods. History shows that many countries eventually face difficult choices involving higher taxes, reduced spending, inflation, or some combination of all three. For everyday Americans, this discussion isn't just about Wall Street. Higher borrowing costs can affect home affordability, retirement savings, investment returns, job growth, and even the purchasing power of everyday income. The financial system is deeply interconnected, meaning changes in government borrowing eventually ripple through households and businesses alike. So, has the great Treasury beer disappearance already happened? Not exactly. Investors continue buying U.S. Treasuries, and they remain among the world's most important financial assets. But the questions surrounding who will continue financing America's expanding debt, at what interest rates, and under what conditions are becoming increasingly important. These are the issues professional investors, economists, and policymakers are debating today. The biggest lesson isn't to panic, it's to stay informed. History repeatedly rewards people who understand major economic shifts before they become obvious to everyone else. Whether you're investing for retirement, building wealth, or simply trying to protect your family's financial future, understanding these long-term trends can help you make better decisions. The smartest investors don't wait until headlines declare a crisis. They prepare while everyone else is still assuming nothing has changed. And that may be the most valuable lesson of all.